Hello, everybody. Peter Murphy and Chase Clark here with the Buying Tampa Bay podcast. Commercial real estate is on everyone's mind these days. They're talking about the explosive growth of the apartment market and the potential crash of the office market and residential reuse trends for retail space and Class B or C office space. And meanwhile, all over town, we have new Class A construction in progress, new restaurants, retail, services developments going on, brand new entertainment venues opening up everywhere. You know, it's enough to make your head spin. So today, we're bringing back an old friend of the show, Donny Turner. Donny, welcome back. You left us like 6 months ago to pursue a career in commercial real estate. So we're stoked to hear all about it and what you've learned and what you know. So fill us in.
Yeah. Hey, Peter. Hey, Chase. I want to say really quickly, it's an honor to be invited back onto the show. When we started the show, a couple months ago, being a co-producer, now to be invited as a guest, it's a great honor. So thank you. So a little to fill in on what I'm doing and where I've been. So yeah, for the past couple months, I recently joined Marcus Millichap. We're a nationwide firm, 2,000 agents or so, everywhere from coast to coast, all the way up to Canada. And particularly for me, I'm ultra specialized. I'm specifically in multifamily. So that's multifamily residential. Our team, RPH, last year, we are proud to say that we have helped broker the sale of over $150 million worth of apartment real estate here in Florida. We're Florida specific, and we have guys that operate all corners of Florida except Miami-Dade, really. We have guys in Southwest Florida, guys in that operate Ocala, etc. I specifically work in the Tampa MSA, so that's Pasco, Pinellas, Hillsborough, Polk, and even up to Hernando. That's what I do. And I typically do smaller deals, sub 25 units, above 5 units. That's sort of my space. My typical deal size right now is anywhere from 10 to 20 units. It all depends. Sometimes, you could be in a market like St. Petersburg, in downtown St. Petersburg, and a 6 unit can go for, close to 2 million, 1.5, or, you could be looking at at whatever else, a 6 unit in the university area of Tampa that's going for $750K. So that's kind of my threshold. And that's what I've been doing so far.
Well, Donny, it's great to see you again, man, and glad you can bring this new realm of expertise onto the pod today. It's two different worlds, right? Residential and commercial, even though, small multifamily is a close cousin to what we do on the residential side. Sometimes when we talk about the details behind these deals, as it relates to financing and who the players are, buyer and seller side, and who the brokers are involved, it's just a whole different universe. So we're glad to get your new knowledge set and new expertise in that realm onto the pod today. So definitely welcome back to you. And,
yeah, appreciate it.
We are really interested in the multifamily sector. You talked a little bit about, you're dealing with anywhere from 5 to 25 units, kind of on the smaller side, not these giant apartment complexes like Peter was mentioning in the intro that we see popping up all over the place along Highway 54, even in parts of Fowler Avenue and 301 down in Brandon. We've had these large national, developers come in and build these, mammoth 300 unit complexes. So there's obviously value there because there's money behind that, lots of money, tens or hundreds of millions of dollars. Where are your buyers today finding value in these smaller projects that are 5, 10, 20 units? Are they looking for just pure cash flow yield, or do they have more of a mindset of long-term, price appreciation?
Yeah, I'd be happy to speak to that. So before I go in, I should probably clarify, there are a couple different kinds of players that do work in my space, and so we break them up into 3 tiers. There's tier 3, tier 2, tier 1. Tier 3 is mostly who I work with, and we affectionately refer to them as, mom and pop. That's the good old fashioned landlord. He or she might work in, unit B, and she's knocking on your door, on the first, asking for her rent. So that's the kind of client that I usually deal with. They've probably owned the property since the 70s, the 80s, and they've been operating it for 50 plus years. So they have different goals and mindsets. It's been long paid off, and they're just holding it for security and maybe for generational wealth for their children. But what I can say is that more and more, what I'm seeing in St. Pete and Tampa is the market is maturing. And what I mean by that is tier 2 is starting to step in. Now, tier 2, that is your professional investor. They might run a family office, or they might syndicate, right? They might have a group of investors behind them that's going in and buying up these sorts of properties that, have been, for the most part, usually held by the same owners for years and years, and et cetera. They're buying up and investing in these properties. They'll probably buy a 10-unit property in the hopes of buying 3 more of them, and just trying to get a foothold into Florida. So that's sort of what I'm looking at in my deal space. I believe it's a good thing. I think that, they're adding a bit more efficiency. They have a bit more, it's a capital intensive business. Everybody knows that. A lot of these mom and pops, the reality is they don't really have the financial resources to upkeep their buildings. It's incredibly inefficient. They don't know the market trends. They don't know where to charge on rents. All of the units are, fully original, 70s vintage. You walk in there and you're like, wow, not a dollar has been placed into this thing. And so they're going in, they're cleaning them up, they're rebranding them. They might call it something like the Hudson or something cute, and then charge, market rate. And so that's sort of what I've been looking at in my space.
So my question on that is, that used to be kind of space that no one wanted to touch, right? It was very unpopular. It was very gritty. You're with a big, a top tier commercial firm, and you guys are in that space right now. So tell me why. I mean, why is that a place that you guys see value, want to occupy? And what is the market dynamic that makes someone like you, buttoned up guy, play in a space that's usually in pretty nuts and bolts?
Well, yeah, and that's what's interesting. In the past 2 years, especially the post-pandemic, I feel like the reason I was hired onto this firm and I joined this team actually was that this little sector has opened up completely in this market. Before, maybe pre-2020, maybe even as early as not that long ago as 2018, a lot of these properties were probably worth $500,000, maybe 750 if you could get the right buyer. These same properties, now they're going for $1 million. Now they're going for 1.5. So firms like Marcus and Millichap, they're hiring brokers that are going in and they're, trying to create this market. And we're seeing that there's a ton of capital migration. There's a ton of people from California. I myself am originally from California, so I get along well with those guys. And there's a ton of people from New Jersey and New York. They're coming down here and they're looking at Florida. They're seeing the actual family migration. People are moving down here like crazy, especially Tampa specifically. And they're seeing the low vacancy rates. They're seeing the growth in rents. Even in this year, we're projected to have rent growth, which is, I think everybody knows that is an exception for the rest of the country. There's very few markets in the country that's going to see even a stabilization in rent or a growth in rent. So very bullish on Florida. I think that a lot of people, they look at this place not only for growth, but also just for capital preservation. They're looking at these properties like little bank accounts, and they know, and they're bullish on the idea that, these property values aren't going to go down, and the rents, they might not explode as they have been in the past 2 years, but they're going to hold steady. And you can't find that in other markets, even in very hot markets like Tennessee and wherever else. They're slowing down, and they're slowing down at a rapid pace because of all the development that they've been seeing. So I think in our little niche of the world, I think we're still looking pretty good.
So in short, you're seeing investors from places like California and the Northeast where they're getting squeezed on yield. Maybe the outlook for rent and appreciation isn't quite as good as it is here in Florida. And so they're choosing maybe to sell out of what they have in those markets, bring their capital to Florida, where they see much more upside potential, down the road, whether it be in yield and appreciation or a combination of both.
100%. And, I think one of the benefits of having a national platform, at least on our end here in Florida, is that we do have offices in the Northeast and in the West Coast. So, Northeast specifically, right? It's incredible the amount of government overreach that's been put on these landlords. It's become politically favorable to go against them and to put price ceilings on their rents, to make eviction incredibly hard, etc. Very pro renter, and we don't have to go into politics on this, but the fact is very landlord unfriendly. And they're looking at Florida and they're seeing the fact that DeSantis just the other week effectively banned rent control in our state, which is, I think anybody in New York would be like, wow, hallelujah, I'm going down there. So so having said all that, a lot of our offices, they're seeing people, they're divesting, right? They're selling their 10 unit in New York for multi-millions of dollars, coming down and being able to buy multiple 10 units and being able to see higher yield and being able to see, just more landlord friendly policies for the most part.
Donnie, here I am in the housing sector, and I was unaware of what DeSantis did about rent control. Talk more about that, because our concern was, and I think it's some of the podcasts we did with you, is that local municipalities would begin to put in place rent control measures. And we'd seen things like that happening, I think, from the city of St. Pete, discussions of increased ceilings on rent rate increases. Tell me what's going on with that. Tell our listeners what's happening there.
Sure. So the crux of it was really in the Orlando market. That's not a market that I'm in, but they were seeing rent growths as high as 20 to 40%. And, that was causing a bit of concern. A lot of people were calling on the local legislature to, stop this madness, right? Whether, is it their fault? I don't think so. But yeah, it's become something of a political hot ticket to try to instill, rent ceilings, etc. And I think it was, I don't know if it was last week or 2 weeks ago, DeSantis came in and he effectively, I don't know the exact verbiage, but he basically made it very difficult, next to impossible, to do rent control. And on the other side of that, he's pledged over $700 million towards affordable housing, either development or conversion. And that's something that we're seeing specifically in our market here in Tampa and St. Pete. And, talking about St. Pete, St. Pete is legendary for being very anti-growth, anti-landlord, etc. I actually saw in the news, either it was today or yesterday, they've actually passed a law, a very landmark zoning law, to being able to convert single family into small multi, so 2 to 4 units. Something that I would have thought, if you would have asked me a year ago, would be impossible. They were just able to pass that. So it seems that the government is beginning to take action on the need for housing.
They may be sorry they did that in 20 years. We'll see.
We'll see.
That seems like a recipe for Suitcase City #2 all over again.
Yeah. 100%.
You got to understand, you got to appreciate everyone's efforts to address this problem. And, legislation, unfortunately, does seem to be not the way to do it, right? Allow the open markets to determine the right solution for this. And to some degree, we're seeing some open market solutions. And so that's good stuff. But, so tell me, how is it though that landlords are going to stay ahead? Let's say the prototypical landlord coming in from New York, looking at Class C multifamily here in the local area, seeing the substantial amounts of deferred maintenance that you described early on, the unit that hasn't been renovated in 30 years. And how do they make that the prospect of that cash flow? They know they're going to have to make the investment to renovate that property in the near term, probably, right? Or maybe they don't. Maybe they're just looking at that and saying, Class C is totally fine with 30-year-old fixtures and finishes. But it wouldn't seem to me that that's going to be a competitive strategy for staying ahead of obsolescence, to allow your units to languish in disrepair or in old-fashioned amenities, and that these guys are going to have to spend some money to make some improvements. So what does that do to their economic models looking forward? Or are they relying on rent rate increases and property appreciation to make up for that reality? Are they just like saying it's not a big deal because all these other factors are going to be so favorable or are going to provide such wonderful tailwind that we don't need to worry too much about those renovation costs? Do you have any insight on that at all?
Sure. I think there's probably two major business plans, right? One of the big, I was talking to a gentleman that runs a family office out of Washington the other day, and he's actually taking the opposite route. He's buying stabilized properties, and he's okay if it's earning, a low 5 cap, because, he's still bullish on the area and he still thinks that the values are going to hold, and yeah, there's different business plans, right? There's some people, they're okay with a 5% return. They don't need a double-digit return, et cetera. They just, they want the security of the asset. They want to put their money in a place where they still think it's going to be safe. I think there's still a lot of value to that. And a lot of investors are looking for that because that's just not what they're seeing in their market. And then I would also say, yeah, there's the typical syndicator, et cetera, that's coming in and they're buying these C-class properties. I think it's very contingent on the financing they can get, right? If they can get, and that's another thing we could talk about, right? That's been throwing a wrench into everything is the craziness in financing. But if they could somehow find themselves in a favorable, maybe bridge debt situation, that this is their business plan, whether it's right or wrong, but they get a low interest only payment. They go in, they put in all the CapEx, and they're able to flip all the units and get it renovated, put a nice, pretty paint job on it, rebrand it. And maybe, when they got in, literally the rents were still at $550, right? Maybe they haven't had a rent increase since who knows when. And they're able to put those up into $1,500. Now the numbers make sense. And then they can sell it at a stabilized cap, somewhere, in the 5s, et cetera.
So are you seeing that your investors are underwriting these properties at 5%? I mean, is that kind of where you're seeing the floor is a 5% cap rate?
Yeah, it depends on the area. Some buildings are still trading at ridiculous caps and in the high 4s. But I think on the kind of stock that I look at, mid 5s, maybe low 5s. It all depends. Some in the tertiary markets, like in Pasco, 6.5 is what we're looking at, which I think is pretty great for those areas. Yeah. The university area, Suitcase City. We were able to recently trade a property. Now it wasn't a traditional deal. It wasn't an investor that bought it, but it did trade at a 5.5 cap. So that's sort of what we're looking at.
Yeah. So our experience is, underwriting is one thing, right? You underwrite it at a 5 or 6 cap. Do you have any experience in following up with some of these buyers, a year or two down the road to see what their real experience is financially on these?
We'll be back after a quick break.
You hear a lot about supply chains these days because if the past couple years have taught us anything, it's that an efficient, well-managed supply chain is absolutely critical to keeping businesses successful and consumers happy. I'm Will Haywood, and I host a podcast called All Business, No Boundaries, where we talk about supply chains, how they work, what happens when they don't, and the innovations that are redefining what's possible in the world of logistics. Listen and subscribe wherever you get your podcasts.
Me personally, no, but we do try to keep, good contact with our investors and see what they're doing. I talk to a lot of investors that have bought from us, years ago, but, the caps back then were a little bit more favorable. We're going to see, a lot of people did come in and they were coming in hot and heavy, even as early as last year, buying things at a high 4 or even a mid 4 on some of these properties. So we'll see where they shake out. I can't say yet.
Yeah.
And this is so mind blowing. I mean, because it wasn't long ago when you would look at a Class C property as a relatively high risk asset in the residential real estate investment economy, right? And so you expected a real premium on rates of return to account for that higher risk. Isn't that all what risk and rates of return is about, right? Higher risk, you expect a higher rate of return. Now it seems that multifamily, even in Class C, is generating rates of returns very similar to what you get in far lower risk, at least from our perspective, Class A single family. I mean, this is odd to me, right? I mean, what is it that's allowing folks to feel so secure about Class C multifamily, which by many definitions has different risk profiles than Class? It seems like obviously the one that would be heavily, I would say, have a strong impact on that would be the idea of multiple rental streams from multiple doors. But at the end of the day, is that enough to make up for this rate of return parity between Class C multifamily and now what you can get in Class A single family? What are your thoughts on that?
Sure. I mean, what I can say to that, well, one thing I will say is, we pride ourselves, specifically on my team, to be good sellers. We try to achieve the best, lowest cap rate for our sellers that we possibly can. And we're able to do that by exposing the asset to out-of-state capital. And you got to remember, an out-of-state buyer, they have different expectations and they have different goals, right? It's not necessarily purely return driven. But I think a few attributes about the asset class that I can say to defend it is that, I mean, it's still the darling of the industry right now. People are still looking at the lack of affordable housing. They're still looking at the low vacancy rates. They're still seeing the rent growths. They're still seeing the positive net migration. And the reality is, you buy a 10, 20 unit garden style apartment, they're not building them anymore. You purchase one of those bad boys in Pinellas County, you just bought yourself a very rare thing, because good luck trying to build another one of those. The only thing that most municipalities will let builders build is Class A 125, 150 unit plus. And unless you are some big fund, you're not going to be able to do that. So I think the lack of supply, and I think the bullishness in the area, it's still a darling of an industry.
So Donny, speaking of development, are there any secondary or tertiary markets here in Central Florida that you're aware of that are still, small multifamily development friendly, where you can go in and build quads or build an 8-plex or build a 12-unit walk-up? I mean, are there places you can still do that relatively effectively here in Central Florida?
Yeah, I wish I could speak more to that. I'm not the land guy. I'm not the development guy. We do have land guys, and that's what they do. Most of my stuff is, the older vintage, in place apartments. But I will say, right, that all the development, it's heading north. I mentioned Newport Richey and Pasco. I mean, that's all we have left to go to is going up north into those areas. But I mean, even over there, that's all I see, right? When you drive up the corridor, it's just that Class A, 100 unit plus. I mean, and the reality is it's pretty hard to make it profitable to build that garden style apartment complex these days, right? Almost the only way to make it possible is to build 100 unit plus.
Well, it's interesting because we were talking to a friend that was in town this weekend from Bowling Green, Kentucky. And that's a pretty, it's a small university town there in southern Kentucky, about an hour north of Nashville. And, they seem to indicate that they're in town. You can buy lots, half-acre lots, zoned for multifamily for around $85,000 still.
Wow.
And then you could build an 8-plex for less than $1 million right there in the city limits. And I just blew my mind because you can't even buy an 8-plex. You can't sniff one for, less than $1.5 million around here, much less a new construction one that you've been able to build in an urban infill, decent area next to retail. So we just don't have that kind of market that I'm aware of anywhere here in Central Florida. Some of that's due to zoning. Some of it's due to just the massive growth we've experienced in the size of our area versus a smaller market like Bowling Green. But to think that there are opportunities like that exist in significant university towns somewhere in the South, I've heard anecdotally that is attracting a lot of investment money as well, to some of those markets where you can achieve a higher yield and potentially be in for well below market value if you're doing development.
Yeah. I mean, if I could get that, I would jump on that all day long, right? That sounds incredible. I would imagine, I would want to see, what are their trends, right? I know a lot of markets are seeing declining growth. There was a big burst post-pandemic, and now that's starting to slow down. With being in an interest rate high environment and with the labor markets finally starting to slow down, who knows? I don't know much about Kentucky. I'm sure it's a great place.
Yeah, that's the key, right? You've got to have growth in population and the type of growth that demands this kind of multifamily housing, right? Because it's not everybody that wants to live in a 2-bed, 1-bath garden walk-up built in the 60s, right? I mean, that's either a location play or it's a particular family demographic.
No, that's 100% right. I mean, I like to describe it. It's middle market housing, right? If we're looking at, the nicer class C plus, C plus, B minus garden style, the stuff that the syndicators are flipping, right? It's the young families or the young couples that aren't necessarily buying houses yet. I think that's another thing to speak to the bullishness of small apartment buildings is the fact that, with the mortgage rates staying high, with the builders still getting squeezed, it's going to be harder and harder for them to buy single family homes. So they're going to stay in this middle market housing. Not everybody wants to live in an A-class apartment building. Not everybody can afford it. And not a lot of people want to stay in a duplex just because, of typically the demographic in the area, right?
So yeah, that's probably correct. And so we'll have a sweet spot that type of product fills. Yeah, as you've been talking about all of this though, I've been in this area now for 25 years or so, and I've watched construction and development on both the residential and the commercial sector push north at a frenetic pace. And I haven't seen it anywhere close to that moving east or moving south, right? We have development certainly east. We certainly have development in the south, but there's nowhere near the amount of development and opportunity, as you said earlier, in those markets as there is in the north. And so intuitively, I'm thinking Pasco County, which was derided initially for the huge investments it made in infrastructure and giant roadways and all the kind of stuff that it had going on up there, and roadways to nowhere for a long period of time, seems to have created, a massive opportunity for development that wasn't foreseen and certainly wasn't planned for in South County, south of Tampa Bay, and East County, east of Tampa Bay. Is there something else going on there that I might be missing beyond just like the prescience of the Pasco County government to create that kind of a template that would make it prime for development now that we're in the state that we are? Is there something else that moves development that way and not east or south? What am I missing as I look at the landscape of Tampa Bay for why all that opportunity is moving north? Do you have any ideas on that? And Chase, maybe you have some thoughts on that too.
Me personally, no, not necessarily. But, one quick note about that market, I've been working in that market a little bit in Newport Richey. It's pretty interesting, just talking about my specific asset class, the middle market. I mean, the rents are still, in the low thousands. They still haven't exploded like they are in Pinellas and in Tampa. So I find that interesting, and I find that to be an inevitability. With the growth coming, I mean, there's nowhere else, from where I look at it, there's nowhere else to go. They're going to keep building north. They're going to keep going up Veterans Highway. So that might be, just looking at the path of progress, that might be something for people to look at. But I don't know, Chase, do you have any ideas?
Yeah, I mean, the road infrastructure has been key, but, one of the keys to development, specifically in Pasco, where you had 4 or 5 landowners that owned all the land from I-75 to US 19 almost. I mean, you had these Wiregrass Ranch, Starkey Ranch, Mitchell Ranch. You had these guys that owned thousands of acres along that corridor that made it very easy for developers. They didn't have to go and assemble property from, 20 or 30 different people to build a 1,000-unit home development. They could talk to one guy and get, 500 acres and go to town. So I think that definitely helped, along with, the Pasco government. Really, they were derided for being negligent early on, right? I mean, they were allowing all this development without infrastructure aside from roads. I mean, the state put the road in, not the county. And now they've, caught up with impact fees and things like that in order to, establish that infrastructure up there. But it is wild driving down Highway 54. I mean, you got a 6-lane highway. I think they're adding like a new stoplight every week on that thing. And then traffic counts have got to be in the 5 digits at every intersection, and crazy opportunity for retail with all that housing going in. And I mean, I don't know how many thousands of apartments are up there, but I know that there's like 4 or 5 mega complexes under construction right now, Class A, along with all the residential. So really phenomenal development corridor, probably unlike anything we've seen in the state of Florida in a long time, concentrated on one highway like that.
Right. It's really pretty remarkable to watch. And it seems like every couple of miles, not only do you have a mega apartment complex, but retail seems to know something we don't, because they're building to beat the band a new grocery store anchored shopping mall or a distribution center from someone very large. I mean, that seems like that punctuates the landscape with far too much density, right? It's like, do they need a Publix every 3 miles? And that's what they have up there. And evidently they do, because every one of those Publix parking lots is packed. So it's really remarkable to watch all of that come together in that market, and to be a longtime resident of this area and to see that. And of course, all my neighborhood boys are bemoaning it and deriding it for how horrible it is. But they now have a Chick-fil-A less than 3 minutes in every direction of them. So, they're happy about that. So anyway, that's just a side conversation, really wanting to know if you guys had any. So I guess the point that you're making, Chase, is that the guys in the East County and South County, developers didn't have similar land acquisition dynamics to be able to kind of assemble parcels as readily. And we didn't have the same kind of investment in state road development in those areas to allow for now local development to come in hot and heavy the way it is in Pasco.
Yeah, and some of that is environmentally impacted. You've got the green swamp, to the east near the Polk County line that's going to prevent any kind of road construction or development in that corridor. You've got the Hillsborough River watershed that has prevented Highway 54 from going any further east than Zephyr Hills, and so you've got that artificial barrier there at Highway 301, where it's very difficult to go further east. And then if you come south from there, you've got land that's divided up into 5-acre lots, and there's thousands of owners of that land, very hard to assemble land. Even the strawberry farmers don't have plots that are any bigger than 100 acres left in Hillsborough County. So very, very limited now. And they were running into this challenge when they were looking for sites to build a new Rays stadium, is you just cannot find large chunks of land in Hillsborough County anymore. I think someone told me anecdotally the other day, there's like a dozen parcels of land that are left that are privately owned that are larger than 100 acres in this entire county. So that's very interesting to think about, when it comes to development, because you don't need 100 acres to do a development, but you do need significant chunks of land if you're going to build these mixed use, multi-purpose type master plan developments that people really like to build. And like we're going to have built up there at Highway 56 and 301 here shortly in the Three Rivers Ranch, which is starting to sell off its thousands of acres of land there along 301. They're building this nice new Tampa Palms-esque master plan golf community up there on several thousand acres. So there's a few pockets left like that, but not many.
Right, and that's the eastern anchor of that whole corridor, right? So we're still talking about the same linear geography. So fascinating stuff. And you're right, big environmental constraints out east and out south that would really direct the growth north and south. So Donny, let me ask you this question as it comes back, bringing it back to the Class C asset space. Are owners able to transition their properties from Class C, where that's a lower end product, there's some additional risk exposed there? How much action are they able to really kind of input on these properties to transition it along the path of progress from Class C to Class B, for example? Are you seeing any owners who are making the kinds of improvements they would need to make to really advance their assets? And is that worth it financially for someone to improve a Class C asset into a Class B asset? Can it even be done? And is it worth it economically? Are you seeing any kind of resales of what now are Class B assets that kind of looked like they once were a classic Class C opportunity? What are you seeing in that sector? Are you seeing anything?
Oh, sure. I've been focusing on, the Pinellas County area. So, St. Pete, etc. Even areas like Dunedin and everything else where, I haven't been in this market long, but I've been hearing from a lot of people just how much it's changed, right? In these markets, and just the amount of growth and everything else and all the development. So, to further your question, so were you asking how are they making these improvements to flip it into B, or if they're able to?
Yes, and like will a Class C area, like what's derisively known as Suitcase City, right, or
Sure.
Sulphur Springs, here in this central area of Tampa near USF, is there chatter that area can move out of that very challenged dynamic that it's in right now to be a more stable investment asset, more of a Class B community, right? Now, I know that you've got some Class A construction going out along Fowler Avenue, which is the main corridor through that area where USF has a big presence, as well as Moffett, and that's where the old University Mall is. And now all in and around that area, you've got Class A, but that's right on Fowler. Will you see what is firmly Class C stuff and very economically challenged stuff that's a little off Fowler? Will you see that start to move up the food chain? Will you see quality dig in deeply to that area? And should investors be considering buying that stuff with the hopes that that's going to be just a majorly better market to invest in a few years from now? Does that question make sense?
No, it does. And I don't know how much I could speak to it. That area, I think you guys would know more than I do. It's just been, it has that reputation, and reputation is sort of hard to shed. If you look at even Ybor, right? That's an area that a lot of people have been hoping and putting a lot of money into to try to change, and it's been difficult. I don't know why. I can't speak to why, but it seems that some areas are just more akin to you could call it gentrification. I know that's kind of a loaded term, but to sort of gentrify. Another neighborhood, right, is Seminole Heights. A lot of money's been going into there, and a lot of people have been working to flip that area, and I think it might happen. A classic success story is Hyde Park, right? That's an area that I know was solidly pretty rough, and now it's not B anymore. It's solid A. I don't think anybody would argue with that. So for the university area, who knows? My job is to sell future cash flow, is to sell optimism. But if I was to advise a client that is looking to invest in that area, I would definitely tell them, I would buy an asset that has a suitable cap rate, that does have room for value add. Would I advise them that, would I write it in my pro forma that it would flip into a Class B asset? Probably not. But definitely something I would, something that's unstabilized, to look to stabilize it, maybe in the underwriting to not over improve. And, it's sort of look at their business plan. Do you see yourself owning this in 10 years? If you do, maybe it'd be worth it, 5 years down the line to reevaluate the area, see what has happened, with this Class A development, et cetera. Is it worth it to put even more CapEx and then to rebrand this asset? And, depending on the units, right, and depending on the street, I think when areas start turning, I think you guys could attest to this, it almost becomes street by street until it fully turns. And that's something that is exciting about our market, Tampa and St. Pete, is that there are areas that are turning, but it kind of turns to street by street.
Yeah, one thing that is interesting to me, I kind of see a common thread in some of those areas that you mentioned. Like some of the challenges in Ybor are product challenges, right? You've got a lot of small homes down there on small pieces of property, where they're not conducive to families, right? They're conducive to single professionals, maybe young couples. But once they start to grow a family, they can't live in Ybor anymore. They feel like they don't have enough space down there. We've got 2 bed, 1 bath, 1 bed, 1 bath predominant, footprint or floor plan units in Suitcase City. And are we looking at potentially a situation where that's just going to be an obsolete product or a product with a ceiling on it, right? So the only option becomes to elevate that area is complete redevelopment, right? You can't take a 1,500 square foot duplex with 2 units on each side and turn that into Hyde Park, right? Sure. You've got to have nice single family there, or you've got to have more upscale multifamily. It's just, there's a ceiling on that product, and it's only ever going to be what the ceiling will allow it to be, right? We don't see duplexes scattered throughout Hyde Park, right? We don't see quads. We don't see, there are some nice garden walk-ups down there, right? And there's some nice, gigantic single-family homes that were grandfathered into a multifamily arrangement. But by and large down there, you see beautiful, large single-family homes on decent-sized lots with nice fenced yards and, walkable streets and things like that, close to retail and restaurant, which is another thing like the university area seems to have struggled with, is how to coordinate these efforts, right? And the university mall development is so interesting to me because it seems like they're trying, right? They're pushing so hard. We've got a Class A apartment complex going in there at the university mall. We've got nice restaurants like Longhorn, Portillo's out front there, really nice looking gas station. We'll see what will become of the half torn down retail at this point that used to be the mall, right? But beyond that, you go 3 or 4 blocks behind the mall and you're into this product, right? That is going to be obsolete if you're talking about elevating it from C to B plus or A minus, right?
No, 100%. I mean, I think, there's always going to be a demand for affordable housing, right? And I think a lot of people would argue we need more of it. I remember in certain markets, I'm just speaking from my experience back in California, right? Where duplexes these days, $2 million, $1 million a unit, right? And, performing like at a 4 cap, et cetera. So there are areas like that where they, it was just by the force of nature of Silicon Valley that it kind of just got bulldozed over. Even if they're duplexes, they still command high rents. And I'm not saying that'll happen to university, but, I think
it's going to take a catalyst, right? Some kind of crazy catalyst to make that kind of thing happen, right?
Yeah, 100%.
Yeah.
So
well, it's a fascinating market trend to observe and to be a part of. And so I love that you're in it. I love that you're watching it closely. Are there any other, insider information, anything that would be helpful to some of our listeners right now about, areas of trends? Are you seeing any trending in the space where people are starting to pay a lot of attention to, and we ought to assume that this kind of a trend will lead to something good, something some kind of a sustained investment growth for this sector? Are there any things that people are doing to their properties in the areas of renovation that might be indicative of a trend, or certain like key hot spots within our market that you see just a lot of money going into? Anything like that at all, Donny, that you've seen out there, given your rather extensive now marketplace perspective? Anything that we should watch out for and tell our investors about?
Sure. Well, let me think. I think I've been operating mainly in the Pinellas County, right? And a lot of, I could say on the negative end, a lot of pressure that's been happening on these landowners is insurance. And insurance has been coming in hot and heavy, and it's been causing a little bit of distress. So talking about opportunity, et cetera, some of these properties, might be coming up on the market and fairly soon. I've been working a lot along the shoreline, talking, Treasure Island, Madeira Beach, Reddington Shores, et cetera. And there's still very high demand for those areas, despite the insurance costs, and mainly because of Airbnb, and if it's possible to Airbnb. And so that's another thing. It's become a perfect storm. Like, if you don't have the zoning for the Airbnb, if your insurance costs have literally tripled, there's been owners in those areas that have been, hit very hard. and that's been causing a bit of distress. So that could be something of opportunity, if that could be turned. And I still think there's still plenty of these assets, these I'll call them legacy assets, where the mom and pops have been holding on to them for decades throughout the area in Pinellas County. That if somebody could go in there and turn the units and reposition the asset, that's a ton of opportunity as well. Speaking to renovations, I guess, well, putting in necessary CapEx, a lot of times there's a lot of deferred maintenance. So being able to have the resources to fix up these properties and bring them up to date. Yeah, updating the kitchens, just, these basic things that you do, especially for single family, right? That's what the tenants want to see. They want to see the updated flooring, the cabinets, the countertops, etc. And paint goes a long way.
Fantastic. It was very interesting, and that's a very helpful perspective that for a while there, we were seeing a lot of beach towns along the coastline really wrestle with the issue of whether or not they would continue to allow short-term rentals. Mm-hmm. And ones that we're quite familiar with that have historically allowed for them were coming up for municipal votes on whether or not that was allowed. And a lot of those have been postponed due to some legal challenges, but we know that that's a headwind. We know that the insurance issue is a big headwind for the owners of investment properties. We know that rising HOA fees are going to push a lot of opportunities to the fore. And so, we've been telling our clients, and it sounds like you are too, watch this space. Likely, whatever market distress is in the works right now, and there might be some of it before the year is out, is going to create a fairly decent buying opportunity for some who just are sick of it or can't weather it. And so hold your cash at the ready. And it looks like some interesting opportunities will arise before too long. So,
yeah, I would say so. In those markets, your zoning is, if you got yourself some commercial zoning, or if you can possibly work with the municipality and convert it into commercial zoning. I know there was a client that it was zoned multifamily, but he was sandwiched by hotels, by commercial zoning, and it once was a hotel, and he was able to get it flipped, to get it grandfathered in. And that was able to explode the amount of money he was able to command for selling his asset. So, commercial zoning on those beach properties, it's as good as gold. And if you don't have it, and if you can't have it, and just within, hopefully something happens with this insurance, could be sitting on a ticking time bomb.
Yeah,
well, sorry, go on.
Another piece of legislation that we talked, that I think got signed around the same time as this rent control ban was this tort reform as it relates to insurance. Is there any advice or any optimism that you can share with clients right now in regards to where you see that taking insurance premiums possibly for them? Because we know that tort issues were some of the biggest drivers of the increases in these insurance premiums. They like to blame the hurricanes, but in reality, all the experts said, no, it's the lawyers that are the problem.
Yeah, I can't speak too much to that. I think you know as much as I do. I've been telling people, you need to underwrite it, right? You need to be extra conservative when it comes to that insurance expense, because a lot of people, when out of state capital, they don't take that into account. So definitely write that in, and be pessimistic on that front. Don't expect it to go down. And for the owners that are feeling the pressure, I think a lot of people in my space, the mom and pop space, they're overly afraid of vacancy. And I'm not really sure why. I think it's a little irrational, especially in our market. But hey, sometimes they just don't have quite the perspective. I see it as a market perspective. I see all kinds of properties, and I look at all kinds of rent rolls. They only see their property, and they only see their rent roll, and they only know what business has been done, for the past couple of decades, right? But I think being unafraid of the vacancy and having to raise the rents, because that's just the reality. Well, with the utilities going up, with insurance going up, you are fully justified to raise your rents and to pass that on to the tenant until these have been resolved. So
Donny,
that's really all I could say. Yeah.
Speak a little bit more to that, because that was very interesting that you said that. People being too afraid of a vacancy, right? So is what you mean there is that existing owners of properties are reluctant to raise rents because they're afraid of driving a tenant out of that property and then sitting too long on the market with a vacant unit. Is that kind of what you're saying? Is that a rational fear in your perspective?
That I think people put too much credence on it. I think people are a little too afraid of it. As we spoke to earlier in this podcast, one of the main drivers and one of the main reasons why I'm so bullish on Tampa, Florida specifically, is the fact that we're still seeing net migration. People are still moving here. I don't have the statistic offhand. I should, but we're one of the highest growth markets still as of now. I think there's a couple markets, Dallas, Fort Worth comes to mind in Texas, but a lot of other markets that used to be sister cities to us, Phoenix, Nashville, they've been slowing down, but we're staying strong. And so that's sort of the deal. I wouldn't be afraid of vacancy right now. I would be afraid of, staying above water. That's what I would say to a lot of my clients. And we provide a lot of tools to keep that in mind. One of the things we do a lot is rent comp surveys. In my specific little niche, C-class, sub 25 unit apartment complexes, rents are sort of inefficient, right? They don't know what their neighbors are charging. Zillow isn't a very good resource, like single family homes, et cetera. There's no data. There's not a lot of data. And what they typically know to do is stick a sign out in their front yard and hope somebody calls. So what we do is we try to remove some of that, we try to shed more light on it. And we call around and we create a rent comp survey, literally calling owners, hey, so, if I was to apply for an apartment complex, what would you charge me, right? And then going back and then showing people, and they could even use this rent comp survey. And, I would even express to them, I wouldn't expose my financials, wouldn't expose my expenses, but, be able to articulate to your renters, these are what my neighbors are charging, it's substantially more. And the insurance costs are rising. I'm sure you can understand that. There needs to be a rent increase just to be able to stay above water. I think, landlords should keep that in mind. And, and that might sound a little controversial. Maybe renters don't want to hear that. I'm a renter. I live, in a B class, 150 unit complex that was probably built in the 80s. And I can tell you, it's still more affordable than buying a house right now. That's the reality. Going into a 6% mortgage, and I don't want to get an insurance policy right now. No, pass that on to the landlord. Let the landlord deal with that. It's still affordable. That's the reality. So if you're a landlord and you're listening to this, I would definitely keep that in mind.
Great stuff. Donny, this has been just an excellent conversation, a great primer on some of what's going on in this sector. And I hope a real thought stimulator and interest stimulator for our listeners in entering this asset class. So tell our listeners where they can go to learn a little bit more about you and what you do. Sure.
You can reach out to me on LinkedIn. I'm not very active. I should be more active. Donald Turner. You could also email me, donald.turner@marcusmillichap.com and whatever else.
Great stuff.
Yeah, if anybody's out there interested in getting in on some of these mom and pop deals, they've got a great drip list they can put you on to send you out some information on new properties too, right, Donny?
Yeah, that's right. If you email me, and express interest, we could get you on that email list. Be happy to.
Fantastic. And of course, HomeProp is your go-to manager, hopefully for some of these small assets like this. So what we've talked through here is certainly something that we have the experience to keep performing for you as an investor buyer. And hopefully we can minimize maximize the output of your somewhat passive investment here in Class C multifamily.
No, I love that. Let me tell to your listeners, there's no one better in the business than HomeProp. You want somebody that's going to, get up to bat for you, to use a baseball analogy. You want somebody that's going to be willing to stand up. And, to look at the rent rolls, to look at the expenses, to know what they're doing, and to be able to justify it. And HomeProp, these are your guys. Reach out to them.
Wow, that makes me feel so good that you still say that even now that you've moved on to bigger and better things. So, Donny, this has been a real pleasure. Thank you so much for your time, and we look forward to staying in touch with you into the future.
Yeah.
All the best, Donny. Thanks.
Definitely. Pleasure.